story tonight. The European Central Bank, ECB, has raised interest rates, and this for the fourth time in a row. That hike, though, has been smaller this time. But the bank says it's going to further hike rates to reduce cash from the financial system. They want to suck liquidity out of the system. Now the ECB has been raising rates, and this at an unprecedented pace. It has happened already. The latest hike of 50 basis points was indeed factored in. It was expected. And at the same time, we've seen the Bank of England raising its key interest rate to 3.5%. It was 3%. It's the ninth time in a row that the rate hike has happened, and the Monetary Policy Committee has voted 6-3 in favor of that move. More rate hikes are expected in the weeks to come as well. The two back-to-back rate hikes come a day after the US Fed raised those rates by another 50 basis points. So what do these moves really mean for investors in 2023? Can we get a sense of how these rate hikes are going to move the markets in the year ahead? Let's find out from Anurag Singh, managing partner at Ansid Capital. Always great to have him on the show, along with Mahantesh, Sabarad, the independent market expert. Great to have you both gentlemen on India tonight. Anurag, that buzz was quite strong, and perhaps the hope was as well among the investor community that inflation has peaked. Now it's clear that the Fed isn't quite convinced that inflation has peaked, because clearly its battle against it with interest rate hikes is ongoing, and Fed Powell has indicated that by saying it's not over yet. So what's your reading of the Fed statement, and how much do you think it's going to affect the ebb and flow of the global markets in the near term, in the year to come?
Yeah, evening, Vikram. So Vikram, I think I think market participants are taking out what they want to out of these Fed speak. But I think his message is consistently very clear, and it's reflecting in the numbers as well. So when Powell says that the Fed rate hikes so far have not made a dent in the inflation numbers, he means the core inflation numbers, that too which is directed more towards services. We all should understand that 75% of US market consumption is around services. The inflation, it started from energy prices, went on to goods because of the supply chain, but most of the goods are imported. Ultimately, all of that came down, but then it percolated into housing and services. And eventually, that is the inflation which is more sticky, and it is not making any dent, Vikram, really. So I think he was candid enough to say that, look, let's admit that there is not much progress there. So I think that's the piece which is sticky and important. And that has got a section of the market worried. That's why the market upside is definitely capped. We have a runway till Feb meeting. There is no major policy decision there, but I think the data imminently will come out. Bottom line being, Vikram, we might still slow down. Peak is 1 point, right? We understand we all have peaked. But peak doesn't mean that we drop from 7. Okay, peak also means that we drop from 7 to 6 or 5. But then 5 is not good enough, right? These are 2% inflation economies. We can't work at 5%, 6% inflation rates. So it is still too high. And, we'll have to see what comes ahead.
So the Fed hasn't been able to attack core inflation, and that's the story that they've stuck with. And that's perhaps the truth, like Anurag is saying. But Mahantesh, besides the Fed, the ECB has acted on interest rates too, and they've gone ahead and hiked. So has the Bank of England. How do you see the pressure across the European bourses now and the early part of 2023? Growth pangs are starting to hurt more and more. How do you see that affecting the Indian markets?
So let's look at it this way. The global growth has been indeed affected, and that's an event that is quite unrelated, I would say, to the central bank rate hikes, really speaking. Why I'm saying that is because it does appear that the central banks globally have misread the inflation surge and have been a little late in reacting to addressing the inflation problem. That's why we are still seeing large jumps in central bank rates. 50 bips is a large jump when it comes to interest rates, whether it be by the Fed or it be by the ECB. And in our own case in India, we have seen a 35 bips rise in the repo rate. Having said that, what needs to be done is that the economies to have a sustainable growth, what is really needed is positive real interest rates and not negative real interest rates. Thankfully, in India, we are almost through into that game, and the real interest rates are just about turning kind of positive. You can take any measure of that real inflation rate. It can be linked to the central bank's rate versus the bond yields. It can be 10-year bond yield, or you take any other measure. We're just about going to hit the positive territory when it comes to the interest rates. Now that will sound good news for the positive spin on the economy. That positive spin comes from capex fed by consumption leading to sales growth, PAT growth, and so on and so forth. So the cycle starts churning positively. Somehow that cycle has not yet started when it comes to the developed economies, because they are still struggling with negative interest rates.
True.
And probably they'll take a little while longer to do that.
Yes. So, like Mahantesh is saying, Anurag, considering that growth everywhere is taking a hit, do you think the risk-on sentiment is going to persist across markets? How are you asking investors to position themselves for the rate hikes of the future? Are they looking more and more predictable now? And what is the kind of outlook? Because the volatility in crude oil prices, those could afford, as far as investors are concerned, they need to be much more mindful of that part of the business, as it were, isn't it?
Yeah, well said, Vikram. I think so. I think in all this, we are forgetting the oil risk. We all assume that oil will continue to stay cool. I think so. That's always a risk which can rise up, right? By the way. But coming back to your earlier point on the outlook on the markets, Vikram, very complex times. Here are the three things. All this, look, ultimately, market is subservient to valuations, earnings, and interest rates, which is the third factor we most times forget, because usually they've been stable. But I think after COVID, banks are trying to balance between GDP growth rates, unemployment, and inflation, right? And we've seen the estimates coming from European Central Bank, Bank of England, and Fed yesterday. They all are saying that economies might grow at 0.5% 2023 in 2023, right? 0.5% is not a growth, which means that basically they don't want to call the doomsday, but they want to signal that there's no growth coming at least next year. Unemployment, they want the unemployment to rise, which means that companies' profitability will have to fall first, and then they will retrench the workforce a little bit to come into balance, more in balance with the labor market. And then obviously that is the only point where the inflation will cool down. Inflation won't cool down until the labor market is tight and unemployment is more than the desired rate, which is, so US it is at 3.7%, desired rate is unemployment at least should be 4.5%. Terminal rates, so Vikram, from here, if I look at 2023, I think we all kept on waiting for Mr. Recession to arrive in 2022. Here we are. It has passed, and it's not here yet. And the trouble point is that recession doesn't come when there is a consensus that it's coming, right? It's not that it's going to be a new year. Oh, it's coming, and here we are. Recession is here. It will always surprise us. So I think certain risk elements stay and persist. And we all should be very cautious in terms of equity, especially, look, US market has corrected still, and we are still sitting on 50% cash position, right? So we expect the markets to go down further because the earnings revision will happen starting Jan. Right. Indian market, just a word of caution, Vikram, I've always been saying they've reached the entitlement level. We have gone a little too ahead. These are very expensive levels to buy. Almost every sector is at a 25 multiple. When the economy is running at a 7% interest rates, why do you get to stocks, and risk the capital just to get a, 12, 13% returns, right? So enjoy that fixed stable percent, 6, 7% that you're getting. Wait for the right times. These are very expensive valuations, Vikram.
Expensive valuations, and yes, you can expect more volatility in times to come as well. Mahantesh, do you agree with that point of view? As far as Anurag is concerned, he's talking about a risk-off strategy, especially when it comes to the Indian markets. And even if you look at India's inflation print, along with the contracted industrial production numbers that we saw recently, tell us how you think markets are absorbing the macro data, the kind that we are seeing in recent times. Do you see them factoring in most of it? Are there negative surprises that you see on the horizon that could dampen the current sentiment in the markets?
I think to some extent I agree to what Anurag is saying. Valuation has been the bone of contention when it comes to equity strategists here in India. Some would say that Indian markets are now accustomed to having high valuations in a situation where we have dried FII flows. Unlike 4 5 years ago, where FII contribution to the overall market's capitalization would be high, it is no longer the case anymore. On an incremental basis, if the FII flow, in fact, doesn't matter at all for the Indian markets. So if the domestic investors have been pushing up the valuations for the market, there has to be some underlying reason. And I believe that underlying reason has to do with the fact that most of the listed space companies that you find pushed up because into the high valuation territory are the companies who have been delivering solid profitability growth, come COVID, come demand slump or whatever, right? They've been outgrowing the market. They've been either gaining market share or they command pricing premium for their products, etc. So I tend to believe that while one needs to be a little cautious, Indian markets still offer that upside. And if you want to have 12-13% kind of growth in equity markets, so be it.
Fair enough. But looking at one part of it, Anurag, we've seen credit growth, which has been strong. It has been reflecting in the way the Bank Nifty has moved too. What does that tell you about the future course that the Bank Nifty perhaps may take? Do you see a further rise in the way the financials will move, looking at the way these interest rate hikes have been happening and the way inflation has been moving?
Correct. So Vikram, that's an interesting point. Look, I think just about a year, and we've been having those discussions, Bank Nifty was at 32,000. And just about in no time, in just about less than a year, it is now at 42,000. Plus, I have to last check where it is. But if you get a 33% return in less than a year, and then you ask, well, now where? I think, well, there is no way to go in a hurry. So you've already valued the banks. Now it's the turn of PSU banks. They're getting closer to the book valuation and all of that now, right? Vikram, the credit growth, I'm not too impressed by the 16, 17, 15% number after a very lull or a single digit growth for the last 4-5 years, right? Talk of GDP, I think from 2019 level, with all the flash aside, we're just about 7% up from 2019. So which is like 3%, 7% growth in 3 years, right? So we have barely improved our GDP levels. There was an imminent reevaluation of banking sector in the waiting that has happened now, right? But from here, where do you go now, right? And I still keep telling that because, and I think Mahantesh referred to this point, because of the very few listed companies in the Indian space, all the passive money continues to get invested there. But just for a reference, HDFC Bank sometimes gets more valued than a Wells Fargo out here in US, or hits the valuation of 50% of JP Morgan, which is the world's largest bank. Then I have some reasons to worry, Vikram.
And those worries perhaps Mahantesh is also articulating. But Mahantesh, how far are we in India from peaking in that rising interest rate cycle? How would you suggest dealing with the interest rate sensitive stocks with the kind of outlook that you may have on it?
So clearly, what Anurag is telling about how the Bank Nifty has performed massively in a very short period of time does indicate that there's element of overvaluation that has already crept in. The other fear that you have on the bank sector is that while the credit growth is better relative to what it was in the past, NIMs are likely to now start getting compressed because deposit rates hadn't moved thus far. Now they're moving up quite sharply. They're catching up. So the NIMs contraction will happen. We are witnessing low NPA levels any which case. So that's not a factor that is going to help you decide whether to remain invested in banks or not. But the phenomenon of NIMs getting compressed will mean that their ability to add to the book value will start getting constrained herein onwards. So that leaves the other sectors to look for. The rotation is something that will continue to happen in our markets, right? So while the passive funds will beautifully position their portfolio as per the index weights, rotation is something that is practiced by the active funds to just see to it that they are able to outperform the market. And I think sectoral rotation is what we are due for right now in the markets. And that itself should drive the markets up 5-7%, just like that, by sectoral rotation itself.
We'll have to wait and see how that
the
happens.
next trigger could be budget.
Yes. No, fair enough, of course. That, of course, is something that is on investor radars. But Anurag, you've told us how you don't believe anything that comes out of China in no uncertain terms. But the growing uncertainties over the state of its economy after pulling out those zero-COVID restrictions, that still puts a question on the global growth story, doesn't it? Or you believe it shouldn't matter right now?
No, it does. It certainly does, Vikram. So, growth story, I think, while India is growing pretty handsomely, I would say, otherwise, rest of the world, the growth story is limited. Vikram, we also have to understand, China has attained a level of about, depends on, I mean, again, the information can't be trusted, but between 13, 14 to 15 trillion economy. And when you attain that size, Vikram, it's not, you can't be really growing at 6, 7, 8% numbers, right? Unless you are really making them up. So I think it has attained a reasonable size, and the problems of size really start to kick in now. So, and I think you understand the problems of Chinese real estate as well, right? So I think all of this combined keeps a little moderate growth outlook for the world, right? And when that happens, and with a little bit of headwinds of deglobalization and friendshoring and all of that, I think we need to be a little bit cautious. It is still a bright sign that India is growing, but India has some distance to go to attain its, kind of achieve the potential, right? So I think we should be more focused on that. There is a long way to go. And, there is a large domestic economy that we can rely on, provided we take the right steps.
The right steps. The opportunities are looking very strong. And that's the word that we've been getting from a lot of experts that we've been speaking to. Even right now, I'm looking at what the US markets are doing. The Dow Jones, NASDAQ, S&P all taking cuts of close to 2 percentage points. I mean, look at NASDAQ. It's down about 1.9% right now. The Dow Jones about 1.5%. And yes, more than 1.5% cut on the S&P even as we speak. So Mahantesh and Anurag, we are watching out for all the cues that we can possibly get and always connecting with the experts like you to understand the future course of action when it comes to managing our portfolios, and for all the inputs that you give us, for all the perceptions that you bring to the table. Thank you very much, and we'll keep connecting with you. Thanks very much for joining us on India Tonight.